Hey, what's up, everybody? Josh here, and this is another episode of the Entrepreneur's Playbook, where we help 7- and 8-figure business owners ignite their financial superpowers. I'm here as always with Ron Parisi. Ron, how you doing today?
I'm doing great. We got a third person here, Josh.
You.
So why don't we do some intros?
Yeah, so we have Andrew Hawkins here with us. He is a CPA and tax manager here with CPA on Fire. Andrew, how you doing?
Doing well. Appreciate you guys for having me.
Yeah, thanks for coming on. So Ron, why don't you talk about what we're going to go over today and anything else we got going on at the front here?
Yeah, we're ready to dive in tax season, and what I find with tax season with our clients and folks that in our network is, even though it's tax time, this is the prime time where people are really getting their hands around their financials, looking down the pipe at 2024 and beyond. And I just thought maybe we would just start off with tax planning, tax strategy 101, give a real basic, not basic, but give an overall, have Andrew give us an overall picture of what it looks like to do some tax planning for your business. And let's get it started. I guess the only thing, side note, is for you guys, we're getting some really good comments. So we really appreciate that, really good feedback. Please remember to subscribe to our podcast. And obviously you'll get notifications every time we drop. So just a little reminder there. Back to you, Josh.
Yeah, so Andrew, why don't you talk about what you do with CPA on Fire, and then we'll get into the tax planning side of things.
Yeah, absolutely. Our focus over here is mostly on the planning and strategy side of things as opposed to compliance. And we love working with entrepreneurs who are in that growth phase of their business, who establish their principles and their objectives and have really started scaling their business. And we love jumping in, helping them with the strategy, helping them tailor a little bit of their operations while staying in line with their overall objectives and vision of the company, and tailoring it a little bit to minimize that tax burden, that compliance burden that can slow any business down. So our passion and our skill set is really honed in on relieving them of that burden so they can focus on what they do best, which is growing that business, serving their client base, making the impact that they want to make. And we'll take care of the very burdening item, the regulatory compliance, things of that nature, to free up their time to focus on what they need to. That's what I love doing the most.
Awesome. Yeah, I think one thing I always noticed when I was in the tax side of things is you have these business owners that spend so much time getting these tax tips on TikTok, and they're like coming at you like, oh, can I do this? Can I do this? Can I do this? But the most successful businesses are hiring someone like you to sit there and say, all right, we have this. We're going to do all this tax planning, and then you're going to focus on what makes you a great business. So you don't have to surf TikTok for the latest tax trend, right? Do you see that?
Yeah. And I'll admit, I've fallen victim to those attention grabbing TikToks of just, hey, you can pay zero taxes if you implement this strategy. And really what you need to do in order to protect yourself and make sure you're operating within the guidelines in place is take a holistic approach to your tax planning strategies. There's so many nuanced regulations that go into any position and that are tailored to industry specific companies, things of that nature. So you really want to have a professional on your side to make sure that you're fully aware of all the regulations in place, that you're positioning yourself in a way that's in compliance in a legal standpoint that's acceptable, and you're not going to have anything looming over your head just to save a couple of bucks down the line, because overall that's probably going to slow down your growth, having to worry about that, focus on that. So when you bring out professionals like us, we love taking care of that for you. We love making sure that you're in a compliance standpoint, that you're able to maximize those deductions without putting yourself in any sort of risky position. So you definitely want to take a holistic approach. It's always good to get ideas maybe from a headline grabbing or attention grabbing video, and then ask your CPA if that's something you can implement, if fall within those guidelines, because there definitely are certain positions and activity that the government wants to incentivize, and you want to make sure you're taking advantage of that fully without totally altering the business operations just to save a couple bucks there. So, there's give and take on both sides, and that's where having somebody who's got the vision to take a 50,000 foot big picture view and make sure you're taking advantage without putting yourself in any sort of unneeded position there. So there's definitely a balance to strike.
Yeah. So just because you saw on TikTok that you can rent your house to yourself for 13 days and pay no taxes, and doesn't mean all these things apply to you, right? Like maybe they don't, but I think with successful businesses, they're worried about the big foundational things with their taxes, right? Are you in the right entity, and all these things that have the major effect? And yes, maybe they'll ask about something like renting their house to themselves, whatever it is, but they're really focused on the big ticket items. Do you think that's true?
Yeah, absolutely. There are stages or different approaches you can take when it comes to tax planning. So you've got the yearly deductions that you can maximize. You've got the Augusta rule. You've got retirement contributions. You can hire your kids under certain situations, things of that nature that are really clean cut. Basically, it's black and white on whether or not you can take advantage of it. And so you've got those kind of yearly approaches based on your yearly activity you can implement or not. And then once you take a step back and you've got the 3 to 5 year horizon of where you want to take your business over that time, you've got more meaningful and more impactful strategies that we can implement there and really take a holistic approach as far as building your wealth, establishing that foundation, your financial foundation for the future, while allowing your company to scale at the level that you want it to continue that hyper growth without saving a dollar just for the sake of saving a dollar. We want to make sure your company keeps the working capital within it. And so there are strategies that we can implement there as opposed to just buy a Tesla at the end of the year. That's typically something that will get a lot of views on those videos. They're more impactful, more beneficial to you, and your deductions can be worth a lot more, especially when you're in a growth phase. If you take a deduction this year, but you're moving to higher brackets over the next 3 to 5 years, we want to make sure you're getting the most bang for your buck. And so the timing of those strategies, not just the strategy themselves, can be really key as far as maximizing the return on investment and getting you the most value for bringing on a professional like us. So we really try and take that approach, focus on the big picture there, look at the overall time horizon and business objectives to make sure that timing as far as specific strategies are all aligned in order to maximize the value that we bring to you.
Yeah, no, that makes it makes sense. It's funny, Ron brought up the exact same example of a Tesla when we talked about this a few episodes ago. I feel like you guys are attacking my decision to buy a Tesla, but that's all right. But no, that all makes sense. What I think it's interesting what you said about the timing, right? Because you have things like bonus depreciation that maybe you could go take a big chunk of bonus depreciation this year, but you're in the beginning stages of your business and you're not going to use that as much this year. Whereas if we time this up, you could take much more advantage of it 5 years from now, whatever it is. So I think when you say the holistic approach and looking at a long time horizon, that's the kind of thing we're talking about, right? Like not only what can you do, but when should you do it?
Absolutely. Yeah, that's key. Making a purchase just for the sake of a tax deduction will save you a little bit, but if you don't need it, it's still a waste of money. It's still a waste of capital that could be reinvested into the company and accelerate your growth, which 20% deduction on something is great. If you don't need it, then it's not worthwhile to make that investment. There are certain scenarios where that's always beneficial. If you've got extra capital, you're not going to redeploy it. There are avenues that we could take with just a year-end consulting meeting to make sure that you're minimizing your tax burden. But when you look at, most entrepreneurs have a 5 to 10 year time horizon. They're looking to accelerate the growth of the business. They're looking to scale it as much as possible and make an impact on their community and their client base. And so our benefit that we bring is basically tailoring that tax planning and strategy within those objectives so you can operate in the lane you want to operate in, grow the business to the degree and at the scale that you want to. And we're just going to minimize the tax burden along the way there. And so allow you to have the most capital during that really important phase of the business. Because at the end of the day, there are other variables to consider when it comes to tax planning, and typically cash is king. So removing that cash from your business just to save 20, 25% isn't always the best approach. If you're bringing your yearly activity to your CPA, there's not much. If you're doing it at the end of the year, there's not much that can be implemented at that point. You want to have consistent communication and conversations to be able to truly understand and have a trust foundation with your CPA so that they can offer guidance while you're implementing those strategies, while you're going through that growth and really get the most bang for your buck there. So, and once we put those numbers together and illustrate that value to the client, it's a very easy and clear decision to take this more long-term approach as opposed to just reporting yearly activity. And it's a very common occurrence for them to want to take a step back, to want to take a bigger picture approach to it. And we're happy to help them along the way when it comes to that.
Perfect. Yeah, I know. I like what you said about how cash is so important, especially to these newer businesses. And I think the phrase that we always hear in our industry is don't let the tax tail wag the dog. Don't make these decisions just for taxes. And the thing to remember is most of these tax strategies, they take cash, right? Yes, you can go buy a Tesla, but you got to put out the $60,000 and maybe save 25% of it, right? In taxes. You're not going to necessarily save you're not going to save $60,000 in taxes by buying a $60,000 Tesla, I think is where people get confused. Fine, I won't buy any more Teslas. I get it. No, it's fine. It's fine. But no, so you touched on this and I saw this all the time. People come to you, they do their taxes and say, okay, now what can I do to reduce that? And it's too late at that point. So talk about the timing, like the ideal situation when someone comes to CP on Fire. And Ron, you can touch on this if you want as well, but what is the ideal situation? When do they come to you? When does the tax planning take place? And how does that all work?
Yeah. So to take the best approach to that, you got to consider the alternatives. I typically feel like there's 3 approaches that clients typically take and then come to us in these positions. And one is having no tax planning in place to just report the income that you earn, track the deductions, pass over bank activity, give us access to their bookkeeping at the end of the year. And like you said, typically at that point, there's not much that you can do. You've got to report the activity in an accurate and fair representation. And if you've got leftover cash at the end of the year, you're removing that from the business for a 20, 25% discount on wherever it's going. And that's a situation where, unfortunately, if you overreport your income, assuming all calculations are correct on your return, the IRS isn't going to send you a notice that says, hey, you didn't implement this strategy. You overpaid. They're not going to come knocking on your door and tell you like, you could have only paid this much throughout the year. Unfortunately, they're not that generous when it comes to it. If you look at it from the opposite perspective, if you underreport, you're going to get an automatic notice right away. They're pretty on top of things with the way that they have their matching systems and things of that nature. Unfortunately, they're not going to be on your side when it comes to tax planning and minimizing that liability, and understandably. So when you get past the just one time a year touch point, when you get past just reporting the activity as is with minimal flexibility and planning opportunity there, we really like to work with clients who have established the business and the client base that they want to serve. They've got a proven principle. They're really starting to grow and scale. And we meet with them minimum 4 or 5 times a year to have quarterly and year-end planning calls to make sure from quarter to quarter, from month to month, that they're operating within the guide of what we expected. We've got that 3 to 5 year projection built out, and we're able to establish and implement those strategies effectively. And things change, seasons come, there's variability with any sort of business growth cycle there. And we want to be able to constantly assess whether it's worth the additional compliance cost to implement certain strategies, whether they're in the right entity structure there. And business owners, typically, they have so many different touch points with the IRS when it comes to different taxes they're paying, with quarterly estimates, with income, payroll, Social Security, Medicare. They've got death by 1,000 cuts when it comes to what they face. And so we want to make sure that we're monitoring that throughout the year, that we're there with them as they're approaching every different requirement when it comes to regulatory compliance. And so we like to touch base quarterly at the minimum. Any large transactions come on the horizon, any opportunities present themselves, we like to immediately set up some time to get their vision, understand really what they want to accomplish with it, and offer advice through that point. So we're not slowing down their growth, we're not altering their operations, but we're minimizing the tax burden within the guidelines of the way that they want to operate there. And so that's done through communication consistently, and through trust, building that relationship over time and establishing the value from both sides. And so those are the most successful client relationships that we typically see.
Perfect. Yeah, makes sense.